Hello, Ascension. This is Bill Schneider again. I'm here today with Charlie Price. Hi, Charlie.
Hi, Bill.
Doing well today?
Doing well, yes.
Awesome. We
Sunny
are,
day, can't beat it.
exactly. We're going to continue our discussion on annual giving strategies. And today we're going to talk about IRA required minimum distributions and giving of those IRA RMDs. So like in our past discussion on appreciated securities, we thought the best way to start this would be to go through an example. So we'll do that. Then I'll kick it over to Charlie, and he'll talk a little bit about his experience with this, and then we'll wrap it up. So let's start with an example. Let's say you're a married couple who earns $100,000 a year, 20,000 of which is your required minimum distribution from your IRA, and you want to give those $20,000 to Ascension. You're both over 72 and you must take the IRA distribution each year, except for, of course, this year because of COVID, there's no requirement this year. You have no mortgage, but you can claim $10,000 for state and local taxes. And the standard deduction for your age and married status is $27,400. So the question for you as a charitable giver is, do you take the RMD, cash it, and give the cash to Ascension or to any other charity for that matter? Or do you give the RMD directly to Ascension without going through your checking account? So with this example, we'll start with option one, where you take the cash and then you fund the cash to Ascension. In this case, you would be giving a $20,000 gift to Ascension. Your income would be the entire $100,000 for tax purposes. And you could claim $30,000 in deductions. So you claim the $20,000 for your gift to Ascension and the $10,000 for your state and local taxes, bringing your taxable income to $70,000. And based on your tax bracket, you would end up paying about $8,005 in taxes that year with an effective tax rate of 11.4%. So that's option one. You get a nice deduction, lowers your taxable income, you pay $8,000 and a little bit more in taxes. So option two, though, is when you give the RMD directly to Ascension. You don't take it, you don't cash it, you never see it, you never touch it, you direct it to be given to a qualified charity, which Ascension is one of. So in that case, Ascension would still get a $20,000 gift. Your income will be reduced because you wouldn't be taking that $20,000 as income. Additionally, because you're not giving that gift directly, you cannot take the charitable deduction on that $20,000. I mean, from a government standpoint, this benefit offsets the other benefit of taking the deduction, so they wouldn't give you twice the deduction. So with that, since you only have $10,000 now in deductions, you can use the standard deduction, which is a higher number, which is $27,400, which gives you then a net taxable income of $52,600. And on that taxable income, your taxes would be $5,917. So with those two examples, Ascension or any other charity of your choice gets the same gift. You are able to reduce your total deductions to where the standard deduction becomes more beneficial to you, which is really the main benefit of this method. And that also reduces your taxable income into a somewhat lower effective tax bracket, which in this case, the effective tax rate is only 11.2%. And in this case, it saves you $2,088. Hope that's clear as mud. Is it clear as mud, Charlie?
Yes, it's clear to me.
Well, let me turn it to you then. Why don't you talk to us a little bit about your experience and how your family uses this and sort of why you do that.
Well, so Gail and I have been doing this for using the qualified charitable deduction for 4 to 5 years. And, you know, our pattern is that we take our required minimum distributions toward the end of the year, which also coincides with the year when the time of the year when Ascension is asking for commitments for the next calendar year. So it's a easy way for us to fulfill our commitment without, well, it doesn't interrupt our other cash flow. We can get that taken care of. It's good for Ascension. They know the money's in hand, and Um, it just works well for us, convenient. And if for instance, your required minimum distribution is more than you're given to Ascension, you can split it up. You can split your distribution up to go to other places if that's your intent. And I think it's convenient the first year or so when we were doing it. Gail and I each have our own IRAs,
Right.
because it's an individual thing. So the process is a little bit different at the two investment firms that we deal with, but it's the same. You get a form, you have to tell them where you want the money to go and how much, and then you sign it and turn it back in. It's, I think, pretty straightforward.
And again, the government doesn't care really what you do with your distribution. They just require that you take it, and using at least some of it or part of it or all of it as a charitable deduction is a way to reduce the tax burden on the individual who has to take that distribution, right?
That's right.
And of course, some people need the distribution as part of their, it's core to their living costs. So this might not work for them, but
yeah, it might not be appropriate.
You do have the flexibility. It's a nice way. And again, it's like you said, out of sight, out of mind, right? It's sort of done, and you've given Ascension for the year, and your pocketbook still has cash in it, right? You haven't had to spend any cash.
That's right. Now, if you'll permit me, I'll get a little technical with the Social Security and Medicare deduction.
Yeah, sure. Go ahead.
Okay, so as many people will know, I'm a CPA, and so I get involved more with financial stuff than people who do other things. So this is beyond the income tax savings. There's an opportunity for the effect of this qualified charitable distribution not being part of your income to benefit you by avoiding some additional costs in Medicare and drug costs. And that by reducing your income, you could move yourself into a lower bracket of income-related monthly adjustments is the term that's used. If you're over certain thresholds, you pay more than the standard amounts for Medicare and drug coverage. So there's a surcharge. And if you lower your income, you can avoid some of that.
And Charlie, let me ask you there on those thresholds. They're what's the word I'm thinking of? They're acute, right? If you're $1 over, you pay the higher rate, and if you're $1 under, you don't. Right?
That is absolutely correct, Bill.
So it's you can make a $1 mistake that could cost you several $1,000s in increased premiums or whatever it may be, right?
Yeah, right. And I want to throw in one other thing that just came up this morning. I was on another Zoom call with Lutheran Social Services of Illinois and Cornerstone Foundation, which is their charitable foundation. And they said, even though in 2020, we're not required to take distributions, they're noticing that some of their regular contributors are still using their IRAs as a source of funds to make contributions to support their programs to cover the extra costs of personal protection equipment, or just to support their regular programs that these individuals, donors, are involved with or particularly interested in. So you can use your IRA, take a distribution this year, and have it directly go to a charity. I thought that was interesting. I guess Gail and I are not going to do that, but If we needed the funds, that would be a way to find them.
Yeah, one other thing on this, just for those who might not have IRAs but still have 401ks, this method isn't permitted with a 401k withdrawal. That's the reason I think, Charlie, that one reason that a lot of people move off of their company-sponsored 401ks into IRAs when they retire or change jobs or whatever it may be.
Right. Yeah.
So IRAs provide a lot extra flexibility from a tax perspective than do 401ks, especially when you're retired. Well, good. Well, let's just summarize what we've said here, and then we can kind of finish it up unless we have any other thoughts. So the basic benefits of donating IRA distributions are first, it could reduce your charitable giving tax deduction and thus allow you to claim the higher standard deduction, thus lowering your taxes. It could also reduce your taxable income to a lower marginal tax bracket, which would also reduce your taxes. And it could reduce, we didn't talk directly about this, but it's in the same vein of what Charlie talked about with Medicare or Medicaid. It reduces sort of benefits below thresholds, so you have lower rates or lower tax burdens on those benefits.
Exactly.
And specifically, it's kind of a weird thing right now because with the CARE Act, not the CARE Act, the Secure Act, the most recent act by Congress that dealt with taxes in 2017, IRAs are required, the RMDs are only required at age 72. It used to be at 70 and a half. Now it's 72.
Yes.
But still, individuals can donate tax-free starting at 70 and a half. So there's a little year and a half window there where you don't have to take RMDs, but you can donate. And individual can donate up to $100,000 annually or $200,000 for a married couple. And just remember, the gift must always go directly to the charity, not pass through you. And you cannot claim the charitable deduction for gifts of IRA distributions because you're getting your tax benefits by reducing your income. And always consult your tax advisor, investment advisor. Don't just listen to our knowledge, and even as knowledgeable as Charlie is.
Right.
Anything else to add, sir?
No, I think you've covered it well.
Well, I'm going to just stop sharing my screen here for a minute and put us back in the picture.
I reached for my water in the middle of
it. You can do whatever. Anyway, thank you, Charlie, for helping me with this today and for sharing your experience. And thanks everybody for listening. Thanks to everybody for listening, and we'll sign off.
Okay.